Recorded. All right. Recording. So first case study is Progresso Financiero case. So, so let's see what we got. Okay, so the first question they have is, what are the possible causes of Progresso poor sales performance?
So some of the things I put in for that one were, so they have some organizational language barriers. They have a high CPA, low sales, and then some maybe potential channel issues and maybe not enough market segments.
Yep, I agree. So as my understanding is, it's a micro lending company which should be profitable enterprise, and it's aimed at the working poor Hispanic in the U.S. and their locations where they are at are not producing many sales of loans. They put teams in each one of them, and this gave them like better results. Also, so the company.
Hi guys, sorry I'm a little late.
Hey, no problem.
I just actually walked in the door from getting off a flight from Orlando, so I'm a little bit rushed, but I'm here.
Oh, that's good.
So we're just talking about Progresso case study. We're discussing what are the possible causes of Progresso sales performance. So we're on the first question. So the company had to put together some good talent, and it was not improving its sales performance. The objective was still to get an in-store operating model that would lead to sustainable unit profitability. At this point in 2008, the board of director and their investors were very concerned about the ability of the company to ever become profitable.
Mm-hmm.
So definitely there was like a big lack of sales. They weren't like well trained. They weren't familiar with the culture, I think, in some of their locations. So this is some of the causes that I thought of. So Rebecca, any thoughts, any ideas?
Yeah, I'm with you on that one. I think some of the problems when it comes to like their business model and validation, I think there was some points where they need to make some pivots, because it doesn't seem like the poor Hispanic segment was like being too profitable for them. I think they maybe make some changes on that one.
Mm-hmm.
Right.
Yeah.
And I think too that, I mean, the fact that they're in the middle of the recession and they couldn't get people to basically use their product, which was a little bit puzzling to me. And I think it had somewhat to do, I think, with their target population. And I agree, Caleb, that they didn't go big enough. I think that they were really limiting themselves. I think there is probably more of a market segment, additional market segments, I think that they could have marketed to. But I think also with their sales staff, I think they probably should have done a different compensation model. um,
Mm-hmm.
and not had it be that they only made $8 an hour up until they did like 14 loans. I was, gee, you could work at McDonald's for that.
Yeah.
So
Yeah.
yeah, I think that they really needed to make a change and increase the base salary and make sure that they got some kind of additional compensation for each loan that they originated. Um, and maybe it's a matrix is what I was thinking about how they changed the compensation was maybe doing a matrix between the volume and also the amount of the loan. So not having it be like a straight, $15 or whatever, but having it be kind of like a sliding scale based upon the amount of the loan, that the person takes out. But definitely restructuring that, because I don't think that it really gave the salespeople a whole lot of incentive, because they knew they're like, yeah, I'm not going to be able to get 15, so I might as well not try.
Yeah.
Yeah, so I got one of the major things they should be focusing on is their sales, because that's really what's going to drive the rest of their business. And the poor structure really doesn't help them.
Mhm. So what are the options are available to improve performance? Which elements of the business model are validated? Why do you think so?
So when it comes to improving the performance, they should look at finding more segments to go into to improve the possibility of making more sales. They also need to restructure their sales compensation to incentivize their sales team to sell more.
Yeah, and I think they need a better tracking mechanism. And they shouldn't just be tracking just the actual loans that are issued, but they need to be tracking, the contacts that the individuals make on a daily basis, the applications that are completed, and also the completed loans, so they can kind of see, are they getting good quality leads? I mean, is every lead that they're getting, is it not, are they not closing on it? And also give them training, sales training, on an ongoing basis. It's really very, very important. And I think too that they should start, by hiring people, not just from the store, but actual salespeople that actually know how to sell. And therein comes the need to pay them a little more.
Mm-hmm.
Yeah. I also think like they should push on sales again. Maybe it's needed like more sales attempt that might push bigger loans and be more encouraging of people to take out like a second loans. There seems to be like a lot of effort placed on lending with the small returns, but they could probably raise the interest a bit without competition getting in the way. It seems like the store have a large overhead, something that the company did not have with Sears or Kmart. So maybe they need to better come to agreement with other grocery stores. Maybe they need to rethink using those stores like rethinking using those stores like in general. But I think by reducing the need for such overhead, they could add to profits and also maybe able to raise commission rates, which seems to be highly needed and which would be a good incentive for any sales team.
Right. Yeah. And they
Yeah.
should do more marketing, I think, too, mailers, things like that, which they could easily do. I mean, I don't know how many times I've gotten that kind of stuff in the mail from those kind of subprime lenders. I sometimes even just get like a check in the mail that says, here, cash this, and you'll be in a loan with us. Like, oh, take that baby to the shredder. But they could do stuff like that. I mean, they could also branch out to places like, the dollar stores and, places where folks that have kind of a lower income don't really have are kind of operating on those fringes of the economy. where they could reach those customers a little bit more. And they could also possibly have, you know, a different product for individuals that need shorter term loans that have decent-ish credit, and maybe not do such a high interest rate, you know, give it like an alternative to a payday loan.
Yeah.
Yeah. There doesn't doesn't seem like to be much in the way of upselling, because they may not have very professional sales staff, and the commissions do not allow for enough incentives in order to make like the effort to expand the customer base. So I think one also has to show investors that this direction will lead to profit and make investors feel better about like more investing, like further investing, which doesn't seem like they have any of this.
Yeah.
Yeah, and I don't think that having them go with another brick and mortar retailer like Sears is really the answer, because, you know, people getting loans like this, unless it's around Christmas, and I bet you guys saw that also in the case study, that they really only had decent sales in Kmart and Sears around the holidays as opposed to year round. So they need to look for different kinds of partners. And I don't know that grocery stores are necessarily the only, you know, avenue that they should pursue. They should do some market testing to see, you know, the types of stores that their demographic frequents. And definitely before they go into a new market, they need to do some market testing, because yeah, I mean, to see what happened to them when they went into LA, and it didn't sound like they did really any market research. I mean, they basically just made the assumption that this is the same type of customer, same type of demographic, without really, you know, making sure through market testing. So, I mean, that's really, really important before they get into another partnership or another market.
Mm-hmm. Yeah, I agree with that. Moving on to question number 2, how much profit does the company earn on a new loan with the current number of loans per month at a grocery store location? How many new loans do they need per location to break even?
So looking at it, how many loans did they have at the grocery store location? Was it 77?
Well, so like through the readings, it says that they were expecting like sales over 100 loans per store, and they were only getting like about 60, and just over half of the disbursement that they expected. Also, I mean, the fact that their representatives were only making $8 an hour, and the small commission like every loan. So
Yeah. So I got, when they're selling like 77 loans, they're making 106, about 107. And then when they hit like their minimum goal of like 111, they're making 74.20 per loan. And then 150, they're making 54 per loan.
Did we have to figure out the break even for the group questions?
Yeah, I think so.
Because I'm looking at the group questions and it's asking us to not figure out the break even, but to figure out how they could modify their compensation plan.
Mhm.
Am I looking at the wrong thing? I was doing this in the airport, so I may have been.
Yeah,
Hold on.
I think we were only fine to break even for this one question in the discussion, and then we discussed the compensation plan for the group assignment.
Well, for the group assignment, I have it pulled up here, and the question is like, the first one says how much total profit would Noodles expect to earn if they choose to franchise?
Right, that's on Noodles, right?
Yes, that's on the other case. Okay, so for Progresso, answer the following questions. As a group, you must change the current compensation plan to improve the number of loans made per month. You can change the variable amount, the number of loans needed to receive a payout, or the fixed compensation. Do not waste time trying to figure out a way to break even with lower number of loans. The board will not go for that. Well, it says once you have made your changes to the compensation plan, develop a board action plan to include specific activities. Will you manage activities or results? Will you keep the current AES? Do not expect them to stay with the new compensation plan. Well, it says as a group, compose your responses in a Word document and submit the write-up to your instructor.
All right. So what are you guys' ideas when it came to the compensation plan?
Yeah, like I was saying, have them raise the salary a bit, maybe to $10 or $12 an hour to attract a better quality employee. First of all, I think that's important. And also, they need to have some kind of compensation in the 1 to 14 loan range to keep their employees motivated, even if it's like $5 or $10 a loan. As long as they know there's something in it for them, and then maybe have there be also some kind of multiplier if they get a loan that's over a specific amount. So maybe have their commission be doubled if they get over whatever it is, a $500 loan or a $1,000 loan, because that's certainly more profitable for the company.
Mm-hmm. So I had like a similar idea. I wanted to like make it so it pushed the sales force to go for higher loans or more volume when it comes to loans. So I like had it moving up in like maybe increments of like 10 or 25 by like $5 per loan they gain.
I think there should be like more emphasis on managing the AE's activities. I think they could like do better recruiting job with the customers. With the amounts of customers in these grocery stores, there should be better results in recruiting like more loan takers. And then again, like they need trainings, but like training could go like further, but it still goes back to pay and commission. So the results are a little more clouded because they are not pushing as hard as they as they can for a completion of a sale because of the low commission. It seems like nobody is like motivated enough. Nobody wants to put like the extra mile to convince more people to encourage people to take more loans. So there's a big lack of that.
Yeah.
So moving on question number 3, as a group go. Okay, as a group, you must change the current compensation plan to improve the number of loans made per month. You can change the variable amount, the number of loans needed to receive a payout, and/or the fixed compensation. Do not, it's just the same, I guess. Do not waste time trying to figure out a way to break even with lower numbers.
Okay.
I think we kind of talked about it, I guess, on how they can do better, like to break, like to make it more profitable and to make it like um, run the company like more smoothly, I guess, than what's happening right now. So I don't know if you guys have any thoughts and ideas. We also talked like how to solve all these issues that's going on, and I don't know if you guys would like to add something before we move into question number 4.
Well, I think it's with the compensation. I think it's a two-part. It's a two-part fix in my mind. And how you motivate your people is to give them carrots. And I think making it to where they earn something for those for those loans that they get between the 1 and the 14, even if it's just $5, to give them something for that. And like Caleb said, maybe adjust the ranges where they can make more money, so they're really being rewarded for the higher volume. But I think that there should also be a component for dollars too. So because if, like, for example, if they generate 20 $200 loans versus 5 $1,000 loans, which is better for the company, which is more profitable. So there should also be like a companion matrix fees for dollars, not just number of loans, but also dollars. So the employees are motivated to say, hey, you're only borrowing 200, but Christmas is coming up, or did you want to take that vacation, or did you really think about all the bills that you could pay with this, that kind of thing, and giving them training in that way of selling.
Yeah, so maybe instead of like a dollar value when it comes like stepping up for more sales, maybe it could just be a higher percentage, just to keep it more simple.
Yep. So once you have made your changes to compensation plan, develop a broader action plan to include specific activities. Will you manage activities to results? Will you keep your current AEs? Do you expect them to stay with the new compensation plan? Where will you find new AEs if the current ones leave? So
I think when it comes to the management aspect, I think they should try and like manage the activity side, just kind of keep them within certain business parameters. And then also when it comes to the AEs, when they implement a new structure, they're going to want to push for better salespeople to stay on, and the ones that are low performers, those guys will eventually drop out because they won't make as much money due to the compensation plan.
They could also have benchmarks that, you know, the salespeople actually have to make, you know, within, maybe it's 2 quarters that they have to meet, you know, at least one of their sales goals for 1 quarter maybe. And if they don't meet it, you know, for 2 quarters, so that's like 6 months, they don't continue. So that's like another way to weed out the underperforming sales folks. So you've got kind of the compensation piece where they're not going to stay if they're not making money, but also there's a way to remove them, you know, just from a benchmark type of evaluation, that they're given 6 months to be able to meet their sales goals. And if they don't within 6 months, then they don't stay, and you can replace them with a better quality person.
Yeah.
Yeah. So with the managing activities, by getting them to work harder, and then they would reach more people in more innovative way and be more inspired to do so. So with better wages and better commissions, of course, a good AE would push for many more sales, because with the 15th sale, commissions go up quite a bit, and this would add a lot to their annual compensation. So a good AE would also have the ability to generate a constant amount of leads and applications. So
yeah, so I think in addition to that, there has to be like management tracking. They have to have reports to be able to track what these guys are doing. And like I was saying earlier, that tracking the whole, you know, every step of the process. So is that a daily report that the AEs have to turn in, a weekly report they have to turn in, something like that? So that process can, you know, that whole process from end to end, they can really have a management view into how each one of these individuals are doing, and like each location too. So if they can't even generate, you know, people to talk to, you know, if they can't even get, you know, people to agree to sit down with them, then, you know, then they really have to say, well, is it the person or is it the location? And that way, you know, if it's every single AE within that particular store, then maybe it's a location issue, not a personnel issue. So, you know, that way they can track stuff like that. So the data that they need to track, and also training. They have to have like more than a half a day training at the beginning of their job. I mean, sales is an ongoing, all the time, role playing, you know, motivating, all that kind of stuff. So, I mean, they really have to have a manager that does that with them on a constant basis.
Exactly. Yes. Also, I think there should be a person like a salesperson or a manager or even like vice president should know how to complete a sale and to be able to follow through and they should know their customers, their audience, as well as the salespeople in the company in general. They should also like be able like to design policy and know how to put on a sales promotion. And once they know their customers and their audience, then they should be able to design a sales approach that will reach most of them and a bigger number of customers.
Yeah, my thought on that one is they'd be like promoting the top performers upward, and then they bring in new people, train them, and then it keeps bringing a new pool.
Cool. So
yeah, because you definitely want the person that can actually close these loans.
Mm-hmm.
Actually make the sale, be the one that's training people, making policies. I totally agree. So you've got to identify your stars within your network, within your stores. And if you don't have an overachiever, a person that you can look to that's like your model person, but you want all your AEs to that level you want them to perform at, then you've got to find them on an external. You've got to find that right person that can come in and be that, that team leader, that person that, can sell the product to anybody, like you said.
Yeah.
Yep. So, moving on into the next case study, which is noodles and company case. So, starting with question number 1, what made noodles an attractive opportunity for Kennedy in 1995? So, I think he was visiting New York, and after like having an tasty meal in New York, and in a small Asian diner, there was the center theme of noodles from different influences all over Southeast Asia. So he felt it was a good idea for the way people eat today, and it was healthy, quick, and tasty, with many strong flavors. So he found that noodles is the um, world's most universal food, I guess, and so that's what um, so that's what how he started it, and that's how he got attracted to the opportunity.
Yeah.
And then again, when he went back to Colorado, and he started to develop like the business plan, and this was all new to him, and he ended up finding a location in an area of Denver, signing a lease in 1995, and by June 1995, and by October 3rd, 1995, he opened his first noodles and company restaurant. So that's how he kind of started it.
Yeah.
Do we need to discuss valuation of the franchising versus the company just grows those additional like 250 locations they're on their own? I kind of did just like trying to figure out what the value would be to them of the franchises if they went all franchising for those, because they wanted to grow from 58 locations, which is where they were at the end of, I think, 2002 or 2003, to 300 locations.
Uh-huh.
And I think that they wanted us to figure out like what the profit would be.
The earnings, yeah.
Yeah. So I kind of did a rough guess on that just based on their income statement.
Mm-hmm.
And what I did is I looked at the income statement and went off of their net income for 2002 for all 58 stores. And then I divided that by 58 locations to get an amount per location, and it was about 11 million. And then I times that by, I think it was 242, which was the difference between the 58 and the 300. So that 242 would be the additional locations that they want to open. And so to get like the total revenue for those additional, that average amount where they were at the end of 2002 per location, the 11 million. And then I figured out what the franchising fee or the royalty fee would be for that. And I think the case said it was 5%. And I don't remember if it was 5% of the net income, 5% of the 5% of just the revenue. I couldn't remember, but what I did is I just times the 242 times the 11 million, that sum times 5%, and I came up with 144 million profit off of the franchised units.
So that's like an annual income off of them?
Yeah,
Okay.
yeah, per unit. I'm sorry, in total. If they're profitable, like the current units are profitable at about 12 million a year. But there's so much variation in there because of the fact that, you just don't know how expenses are going to change and all that kind of stuff. But all things being held constant, that was my guess, was about 144 million in profits. Like I said, this is my airport work, so if it doesn't sound right,
I mean,
let's just say, what about this? And so for the discussion on if they just expand by using company-owned stores, I basically took that revenue that they made, that the stores would make, the 242 times the 11 million, would be their entire, would be all their profit. And again, that's thinking that all things have remained constant. But if I recall correctly, they did say that there was going to be a significant capital outlay that they would either need to finance or issue in stock or whatever to fund this expansion. So there would definitely be additional expenses or definitely, additional equity that they're giving out for that.
Yes. Yeah. And their plan was like if they become a franchise, there would be like 50% on the franchise and 50% the company-owned stores.
That's what I think they should do.
Yes.
Yeah, because I ran it like both ways, with it being like all, 244 additional locations being franchised and then all being company-owned. I think what they should do is they should do a split. I think that they shouldn't put all of their eggs in the franchise basket. I think they need to take a step into that without going all in with, the majority of their stores being franchised.
That's what kind of I thought too.
Yeah, that's what my gut tells me that would be better. So they don't have to raise as much capital and give as much of the profits away.
That would also, yeah, go ahead. Yeah,
I thought a mix would be good.
Mm-hmm. Yeah, same thing. I came up with, and I also thought this would reduce the company's capital needs to $25 million over the next few years, because franchising would call for a greater monitoring of everything from trade marks and even logos to operation and performance management systems. So, because all franchisors would pay development fees of $35,000 per unit, plus the 5% loyalties on revenue.
Mm-hmm.
So if they maintained a pure company-owned strategy, this would require almost $80 million in capital by the next couple of years. So by using franchising, the company could grow on other people's capital and possibly even grow more quickly than originally projected.
Yeah, and one of the benefits when they use that strategy is they're able to hold up the quality, in addition to having that accelerated growth.
Yeah, absolutely. Without all of the outlay.
Mhm.
Because I mean, if you're managing all those additional stores, that's a whole lot of personnel, not just at the stores, but that's a whole lot of personnel at the top levels, you know, in their corporate organization that they would need to have to manage all those stores, you know, the regional directors and, you know, all of that. I mean, real estate, construction. I mean, there's so much to it that, I mean, I think that franchising is a good option for them since, you know, they have brand recognition in a lot of markets at this stage since they have almost 60 stores. So yeah, I think it's a good option for where they are at that point in time, but not to go all in with like 100% of their growth being franchised, but a portion of it.
Yeah.
Yeah. It's very expensive to scale. Kind of reminds me of like McDonald's franchising, where they don't go full franchise. They still have like corporate managed.
Right, exactly. Chick-fil-A is the same way. Is that, yeah, the corporate management is still very, very much involved. Yeah, in the way they do things.
Yeah, I like in that case, I think they would need to hire like someone to lead the effort for franchise selection, plus someone to handle like, I'm assuming there will be lots of paperwork, lots of legal work, documentations, and another one in the real estate department who could like be dedicated strictly to franchising.
Right, where it's more consulting and oversight versus actually having to do it. Yeah, and have to manage every single piece as opposed to, you know, having like